All right, we are underway. So I'm Paula Shapoulis with the Blue Ox Business Academy with the Brainerd Lakes Chamber, and we are certainly happy to have you here. Before I get going, I want to remind you that we have a Lakes Proud Business After Hours tonight at the district at the Northern Pacific Center. So that will be fun. There's still time to register. So come to that, and it's one of our first, well, let's see, I think we've had one other business after hours in person, which was really fun at Madden's too. So again, we appreciate all of your support and all of you being here this morning. So before I get going, I will introduce Rebecca, but even before that, as I was saying, there's a lot of bankers here, and our speakers are also in the financing field. And I want to do a quick shout out to all of you. I know the last year has been incredibly crazy and demanding, and there's been so much change with financing, and a lot of businesses that have really, really struggled in the last year. And of course, there's some businesses that have done well too. But I know many financing people who have spent many hours well and above their time in their position to work with businesses. So I just want to give you a shout out and thank you for doing that. So again, you're at Business Financing Essentials. I am going to introduce Rebecca Rowe. So Rebecca, I had a chance to meet her in February. She is new to the area, but does have ties or grew up in the area. And it was just a pleasure to meet her at Newcomers at Mount Skigal in February. So I want to extend a warm welcome to you, Rebecca. And so she's the director of the North Central Small Business Development Center, or SBDC, that you will probably be referred to from here on. So she joined the North Central SBDC in January of this year, and previously worked for the federal government in financial and portfolio management at the United States International Development Finance Corporation. And prior to DFC, Rebecca worked at the United States Small Business Administration, and with investment funds, innovation programming, policy, government contracting, business development, and size standards. And I think one of the most interesting things that Rebecca has shared with us is that she was selected as a Presidential Management Fellow and served in the Peace Corps in Azerbaijan and as an AmeriCorps Vista participant in Clarkston, Georgia. And so she resides in Aiken. Rebecca, thank you so much for being here. And thanks to the rest of the crew for all your work in putting this together for our members. And I'm going to turn it over to you. I'm going to stop sharing here and turn it over to you, Rebecca.
Thanks, Paula. And thank you to the Brainerd Lakes Chamber of Commerce for hosting this event, and especially to Paula for all her efforts. I have the pleasure of introducing our other speakers today. First, we welcome Julie Anderholm. Julie earned both her bachelor's and MBA at the University of Minnesota. She subsequently worked as a healthcare finance professional in the areas of auditing and financial forecasting. Julie has served as an independent financial consultant with the Minnesota SBDCs for over 25 years and provides expertise in financial analysis and forecasting to businesses throughout our area. Julie is also heavily involved in the community. She serves on the board of the Brainerd Lakes Area Economic Development Corporation and is a member of the Brainerd Noon Rotary. We also welcome Mike Paulus. Mike has been the executive director of the Cass County Economic Development Corporation for about 5 years. He serves as a business consultant and a site administrator of a satellite office for the North Central SBDC. Mike excels in financial analysis and is a regional leader in loan packaging and providing financial health checks to businesses in the Region 5 area. Mike contributes to the community by serving as the director of the Essentia Health Board of Directors and on the Mid-Minnesota Federal Credit Union Board of Directors. Finally, we also welcome Matt Dickinson. Matt has over 16 years of experience in banking. He helps financial institutions gain and maintain their knowledge base to manage their IRA portfolio. Matt also serves as a well-respected North Central SBDC consultant, and he is committed to creating lifelong relationships with his customers. So we are happy to be here today as a North Central SBDC, myself, Julie, Mike, and Matt. And we wanted to provide a little background first on the North Central Small Business Development Center. SBDCs provide guidance to help start, sustain, and grow businesses. And there are 9 SBDCs in the state of Minnesota. We are the North Central SBDC in the North Central in picture number 1. The North Central SBDC serves 11 counties, and those 11 counties have over 351,000 residents and about 34,000 business establishments. SBDCs are public-private partnerships and are cooperatively funded by federal, state, and local sources. So through the United States Small Business Administration, the Minnesota Department of Employment and Economic Development, and local partners. And the North Central SBDC is very appreciative and grateful to Central Lakes College and our local partners throughout the region. The North Central SBDC provided 3,200 hours of counseling to 520 local entrepreneurs and businesses in calendar year 2020. The North Central SBDC facilitated access to $20.2 million in capital in CY 2020 for business investment, and we provided over 800 hours of technical assistance in this past calendar year to help manage the impact of COVID. We welcome questions at any point in time, to the North Central SBDC. All services of the North Central SBDC are provided on a confidential basis and at no cost. So at this point in time in the presentation, I'm going to hand over the presentation to Julie for more information. Thank you.
Well, thanks, Rebecca. I appreciate that, and Paula for the introduction. Welcome, everybody, this morning, this non-great and non-sunny morning in April, Minnesota. I know most of you because I've worked with most of you, through the lending process. So I appreciate you hopping on today and just kind of getting a feel for really what the SBDC is doing to try to help clients successfully obtain commercial financing. So our topics for today are 3 brief topics. Really, we're going to look at what the project is, at least from my perspective, a little bit about commercial financing, the background, and hopefully getting the perspective from the bank, from the lenders correctly of how we think of commercial financing and how we work to help our clients successfully obtain this financing. And lastly, our main topic that we're going to cover is what we call the loan package. And it's really our outline to assist businesses in this commercial financing. So that's what we are going to discuss today, and we're going to dive right into our first bullet point. So basically, what's a project? Because I always refer to a project, and if I have businesses online and they're like, what is she talking about? So if a business merely goes through their daily life and life is the same, their cash flow is kind of the same, and then all of a sudden they decide, boy, I need a new piece of equipment, or we are outgrowing this building, or we don't want to rent anymore, but we want to buy a building, or we really need to remodel this area, or we need a line of credit. That is kind of outside their regular business operations and what I consider the project. So they may need commercial financing or some outside financing to help fund that project. So that project could literally just be buying a building, or it could be a combination of buying a building and putting new or additional equipment in that building, or potentially adding inventory. So when we look at the project, it's what's the project or what they want to fund or finance. So that's my perspective, and that's when I work with my clients, is how we look at trying to prepare the loan package to help fund the needs of that project. So a little bit about commercial financing, and I know that there are a lot of bankers online today. So this is my interpretation and a very brief interpretation of what lenders look at when they are looking at commercial financing. And I think it's important that we tell our clients who are business owners what a bank is going to look for, because that will help them better prepare when they go to the banker or go to their lender and ask them for financing. So when we look at commercial financing, I usually tell them it differs from residential financing because most people have a home mortgage, but that process is a little bit different than getting a commercial loan. So we want to make that clear on the front end. There are the application and the approval process is a little bit different. And I would say it's rigorous. And when clients get a little bit nervous about this process, I say, you know what? It's good for you too, because you as a business owner don't want to bite off more than you can chew. And really the banker is your friend to say, boy, this is a reasonable amount for you to borrow. And this is a good project for you to move forward. So I think having a rigorous application and approval process is beneficial to all. The terms may vary. It's not like residential mortgage 30-year terms. And usually the interest rates are a bit higher than a residential mortgage. So I think having clients understand that right off the bat is important. And as we move forward, we often think about the banks talking about the 5 C's of credit, which we have here as character, capacity, collateral, capital, and conditions. And for some of you, that might just be mumbo jumbo. And, you know, where do we even start deciphering this? So to break this down just a bit, we kind of put it into terms that we can hopefully relate to as we're going through this loan packaging process. So just briefly, I'm going to go through these. Capacity. Do you have the ability to repay the loan that you are asking for? Capital. Do you have money? Do you have cash for the down payment and for the working capital it needed for your business operations? Collateral. We're going to be talking about this a lot. These are the borrowing. This is the borrowing capacity of the assets that you either already own in your business or are looking to secure. Condition. What's the purpose of the loan? What's the market in this industry that you're in? What's the economy looking like? How is this a good time for you to be asking for a loan? Character, the integrity of the business owner and the willingness to repay, a super important thing to look at. And we'll kind of talk about how this works into the loan packaging process. I have the 5 C's of credit up here, but then I throw in a 6th. And if you look online, sometimes there are 7, sometimes there are 8. It kind of really depends. But this 6th one is a good one to look at, and it's credit history. And it could maybe roll into that character line item, but it's really your personal credit score. Because what lenders say and think is that if you have a good personal credit score, it's indicative that you manage your personal finances well. And if you manage your personal finances well, more than likely you're going to be apt to manage those business finances well. And that's a really strong position for a lender to know and to feel comfortable with when they are looking at the loan approval. So that personal credit score is important, and it will help solidify, hopefully, your successful approval process. So we look at these requirements, or these 5 C's of credit, and we're going to show how they tie into the loan package. So as we move on, we're already at our 3rd topic. And the 3rd topic is really the loan package and what does that mean? So when people come into the SBDC, oftentimes the question that they have is, I need a loan. How do I go about the process of getting a loan? And we at the SBDC in the North Central region are very familiar with this financing process and the loan package process. We have a great relationship with lenders in all of our communities. I think that for those of you that are attending the webinar today, I think you'll echo that we really try to work together to do what's best for the client. Okay, so when we think of the loan package from our perspective, it consists of 9 components, and we want to pull these components together and give them to the lenders so they can determine if they want to approve the loan and basically move forward, or how they're going to work with that client. So when we look at this, we really want to encourage you, if you do have questions, that to call the SBDC or connect with the SBDC, because we can assist you with this loan package preparation. You're going to be hearing me say that a few times today, but I really want to start right off the bat that don't be scared about anything that we're going to be looking at today, because that's what we're here for. We're here to help you through this process. So as we look to this slide, I know it's a little funky, but I just wanted to take a snip. This is the SBDC's lender's checklist. And these are the 9 components that I was just mentioning. And it's basically the cover sheet to the loan package. So the lenders out there have seen this sheet many times. And because when we prepare that loan package, this is on top. So they know exactly what's included in that loan package. So my next slide is a little bit more clear in just the titles of these. So we at the SBDC feel that in order for a business to hopefully have successful business financing, we want this loan package that they prepare for the lenders to include these 9 items: a business plan, historical financial statements, the summary of project costs, collateral analysis, projections, legal information, personal financial statements, resume, personal tax returns. It might not sound ominous to some, and it might sound easy to others. It depends on where your perspective is. We want this process to be, we want to help in this process and hopefully make it simple for you. So today we're going to go through these 9 steps and kind of how they fit in and how they fit in with the bank's requirements. So if we look at this first, number 1 on our loan package is the business plan. The business plan for some business owners can just be something that they really don't even want to tackle or think about, or would rather write the check and just pay somebody to write their business plan. And I always tell the clients that I work with that can't be done, because a business plan, really, it's all up here in your head. We want to help you and provide a good, solid outline for you to put all those thoughts or all that knowledge about your business and the industry that you have floating around in your brain. We have an outline for you to put it into a logical format so you can share that with the lenders and show them how much you know about your business and how comfortable you are working in this industry. And if they still say, hey, I don't know a lot about this, then maybe they need to do a bunch of research and pull back. If it's a business startup, maybe they aren't ready to start, or maybe they need to do a little bit more background or information checking before they really pull the plug and start their business.
Julie, can I jump in here?
Yes, absolutely.
So just in regard to the business plan, I think a lot of our clients, when they first sit down and they visualize what a business plan is, it's a very detailed document. They see outlines and all these various samples online that I think kind of distracts them. So I guess I'm saying this more to the business owners that are on the call now or will watch this later. The outline we have can help to target you. And by working with us, we can get you to target on what's important. And if you were to look at our outline that we use, about 70% of the outline is the marketing plan. And that essentially should be reflected in your final business plan, 70% of which is going to come back onto marketing. Because if you can't get business, if you can't attract your target group, your customers, then you have a hobby, right? Instead of a business. So well, I think if you just strip it down and you look at it as what's my starting point, it's to complete this marketing plan. If you just needed to start getting some traction on something, that's what I've always recommended that you as clients would do. Because just looking at this, it can be yikes.
It can be daunting.
Yeah.
Mike, and I appreciate that. And the reason why I think it's important to lay these components out is if you look at, like, if we take out the title page is easy. That's the name, your business logo, contact information. So that's already one and done. You have that. Appendices are just things that it might be easier to show a picture of something versus writing a bunch of stuff out. So again, that's pretty easy. The executive summary is just a quick 1 or 2 paragraphs of really your business. And so the meat of it is these 4 areas right here. And I appreciate Mike mentioning the marketing plan, because he's exactly right. If you don't have a market for your product, you don't have a successful business. And if you look at these last 4 components, They are the 4 functional areas of business: marketing, operations, management, financial. The main 4 functional areas of business. And we have them in our business plan because they should be covered. But if you look, like Mike said, there's not a lot of outlier or a lot of extraneous things. We really want to get to the meat of the matter. And we will share our outlines with you. And really, we say that most business plans can be written in 4 to 6 pages of text, 5 to 8 pages of text with appendices. They're not books. No one wants to read a book. Sometimes lenders or maybe individuals may only read the executive summary and look at the appendices. So we want it to be clear, short and sweet. Okay. So that's item number 1. Thank you, Mike, too. Hop in for any other suggestions that you have and comments. I appreciate that. So the second item on our lender's checklist that we want clients and business owners to pull together are historical financial statements. So the first thing I'm going to say right off the bat is obviously this is not applicable to new businesses. If you're a new business, you do not have historical financial statements. But really, again, this is a component that you should already have for your business, and it's just a matter of pulling this information together. So we say we would like an income statement, which I want to make clear that that is the same as a profit and loss or a P&L. So as a business owner or potentially a business startup, the income statement is the same as the profit and loss, is the same as the P&L, one and the same. We want that for the full year for the prior 2 years. The balance sheet, remember, is at a point of time. So that's going to be at the year ends. So we want 2 year ends of the balance sheet. And then we want those same 2 statements for the current year. So if you're applying for a loan in July, the lenders will want to see what your income statement and what your balance sheet looks like through June, because then it's what currently what your business is doing. You may have accounts receivable and accounts payable, and it's good to provide that information as well for the current year. So again, this is all historical information that you should have easily available that we print off and we put in the loan package. That's the second component of the loan package. Out of those 9 components, that's the second. All right, so we're hopping back to that term, the project again. So now remember that when you're preparing a loan package, it's to get financing for your project, whatever it is. So when we're looking at this, our third component is the source and use of funds. So what do you need the money for? And where do you hope you get that money for the project? So the use of funds equal the project cost. So the cost of building the building, the cost of the new equipment, the cost of the additional inventory that you need. So those are the project costs. That's what you're going to use the funding for to pay for those project costs. The source is how these project costs will be funded. How will that building be funded? How will the equipment be purchased? How will the inventory be purchased? The uses have to equal the source. When we look at this, when we're preparing the clients, we always tell our clients that the owner cash or the business owner's cash and or equity are always a part of the source. We hardly ever see projects 100% financed. They are very few and far between. So we tell our clients right off the bat, you're going to be expected to bring in cash and or equity, and we'll help you figure out how much that amount needs to be. And I think, Mike, you look like you might have a comment to add on that. Is that no?
Well, Julie, before you get too far, and I don't know if you're going to your next slide yet, but there was a comment from Peter Nelson about the business plan, and he just said adding risk factors to the business plan is a good idea. It's often overlooked by the owner and demonstrate to the lender that you have thought through these potential issues and how to resolve them. So I just wanted to add that in for those who are watching later. They won't have this chat feature along with it. So thanks, Peter, for that.
That's awesome. And that, yeah, that definitely could be a part of the financial information as well as what, what are the risks? And that's a good point, maybe to just talk a bit now. I think that at the SBDC, when we help people put together a projection, which we'll talk about later, we try to be conservative. So we try to accommodate that conservative position to help mitigate those risks in the industry. So, thanks, Pete. Appreciate
that. So Julie, I was going to answer your question, but then I guess my answer would also touch on Peter's comment in the chat box. But yeah, we get clients that come in and think that they can get a loan without putting any money down. We get a client that comes in and thinks that they can get a loan with bad credit or zero cash in the bank. And, so oftentimes we have to present them with the reality of it. But I think what I like to do is boil it down pretty early and pretty simply to this, that this process of starting to work with an SBDC consultant, starting to do the business plan, is a should you and a could you. So the should you get a loan, could you get a loan? And the could, if you have bad credit and no cash or don't want to put any skin in the game, then then you can't get a loan. And that's pretty simple. The should you then is really where the hard work plays out for us to help you through that business plan and through the projections, prove that you should get this loan, meaning it's going to help you, it's going to make you more profitable, you're going to more than pay for it. So risk factors, as Peter brought up, is definitely part of the should you, because if you can't overcome potential risk factors, then you should not expand or go into business.
Perfect. Great comments. Your should you and could you are kind of my financial feasibility. That's that kind of, same concept, financial feasibility. So I think we'll tie in both Mike, your comment and Pete's comments as we go through, because there's a bunch of tie-ins to what you both just said.
Julie, I'd like to just add a little bit to what Mike was saying in, the should you and could you, even if you can get past those with the consultant, and we think that it's a good idea to move forward. When it gets in front of a banker, there's going to be additional risk factors that they're going to come up with that we didn't think about, that the customer hasn't thought about, and it may be something that the bank's not even interested in. So the more thought that goes into Pete's comment of what the risk factors are and trying to overcome them, the better prepared the package will be, and the better the bank is going to feel comfortable about the thought process behind what they're trying to do.
Totally. Yeah, because we, I always say at the SBDC, we don't have a drawer full of money. We're not the people that are making those decisions. So we want to help those clients be as best prepared as we can. But you're exactly right, Matt. Lenders are looking at it from a different lens because they're the ones with the money and taking on that risk. So really great, good comments, and I'm glad that you guys are sharing them. Please keep doing that. So again, we are talking about the third component. We are at the sources and uses of funds, and basically the project costs and how they will be funded. The one thing I do want to, as we move forward, we split out the project costs by the type of asset or by the type of expenditure that it's going to be. So usually we have line items for land and buildings, then equipment, inventory, and working capital. If you think about it, these are the three main asset types that a business would have: real estate, equipment, and inventory. And the reason you'll find why this is important to kind of keep it in these categories and look at it from that perspective as we move forward. So just like the lender's checklist sample that I wanted to show you, excuse me, this is our format for the source and use. And again, it might not be very clear for you to see on your screen, but I just wanted to point it out what it looks like. So here's the use of funds, and you can see we break it down into land, building, equipment, improvements, inventory, and then other, working capital at the bottom. So this is basically the project costs broken down into these use items. line items. And then at the bottom, we have, where are the sources of funds coming from? Is it coming from a bank? Is it coming from a gap lender? The key point in this slide is that the use of funds has to equal the source of funds. Okay, it's just like a little mini balance sheet. They've got to tie. So this is our format that we work with. The format could look different. If you go to a different SBDC, it might look different if you create it on your own, but this is just an example of the format that we use. So as we move forward, we've talked about the use of funds and the project costs and breaking them down into those categories. So now let's talk about the second component of that, which is the source of funds, which is the gist of this whole topic today. Where are you getting the money to fund the project, right? So we always assume, again, here we're bringing this point back in, that the owner is going to bring in cash. Projects are not 100% financed. So we always assume this when we are putting our financing structures together. So if you've got money to bring into it, it's going to be that plus a bank, or it could be a bank with a gap lender, which we will talk about, or it could be a bank with an SBA program, which we will briefly mention as well, or it could be a combination of the bank, the SBA, and the gap program. So we've got a bunch of options, and I know that Mike does the same thing as I do, is we look at these options in these different scenarios and figure out what's the most realistic to get funded, as well as what's the best for the client, because there are different options that we can look at. I mentioned this just briefly on this slide, that there are other government programs like USDA and Minnesota Department of Ag, Rural Utility Services. There are some for other big projects, or projects that might not be real typical. There are other programs that we utilize and Mike utilizes in Cass County. We aren't going to talk about those in detail today, but if it's applicable or makes sense to the project for that particular business, we will definitely look at. I'm going to highlight this where I say there may be an occasional grant. So I always tell my clients, grants are square pegs for square holes, and they are few and far between. Now, as I say this, the business owners that are listening to this say, I got a PPP, I got a grant I worked with Bladec to get a grant. This past year has been atypical for businesses in the area of receiving grants. A lot of businesses received a grant that would have never, ever been a possibility had it not been for COVID. So I don't want businesses to get in the mindset that grants are a typical method of financing or getting working capital, because that is not the case. If you think about it, the grants that most businesses obtained this year were because of COVID. Once COVID is gone, it's not like there's going to be a plethora of grants out there to help fund things. So I want to be very clear about that. And I don't know if Matt or Mike have anything to comment, add to that.
Yeah, I would definitely reiterate what you said about grants. I mean, they never happen. But what I've seen and what I've advised against for some clients, I think right now they see capital as being super easy to get, because I believe it's up to 150,000 with the EIDL. You can snap your fingers and get funded at 3.75% right now by the SBA under the CARES Act, which, okay, it's good and bad. It's easy money. It's fast, very little underwriting. Unfortunately, you're still accumulating the interest over the 6 months or year or 2 years that you might be able to waive payment. But I think it's kind of poisoning the well a little bit, because it's so easy to get that money, but it's typically not. And it's going to end where it's going to go back to being more of a stringent process. And I encourage people to continue to look at it with your own internal stringent process to make sure that you really do need that EIDL money and you really should get that loan. So right now I'd put, even though it's a loan, I'd put that EIDL money in with grants.
Thank you. Matt, any comments that you want to make on that?
Grants are, people will take a look at grants and just trying to get them because they look at it as free money. A bank's going to look at, a grant as, it's free money now, but are you going to be able to support the business with or without the grant? And if you can support it without the grant, and a grant's free money, yeah, go for it. But the underwriting is still going to be the same with a grant or without a grant.
Okay, thank you. I appreciate that. So we don't want to be prophets of gloom and doom, but we also are not going to be Pollyannas. We want to be realistic and really prepare business owners in the appropriate method when we look or manner when we look at grants as a very slim possibility and probably non-existent. So let's talk a little bit more about the sources of these funds. So if you can see, the bank is at the top, because that's going to be probably our primary focus when we work with clients is let's work with a lender, and that might be where it stops. So when we look at a bank, let's kind of just go back and just dive in a little bit from a bank's perspective on commercial financing. Banks are always in a first position. What does that mean? So when you get a business loan, you are going to pledge collateral, assets that you're going to pledge against that loan. If you default on your loan and don't make payments, the bank takes the assets that you pledged as collateral, they sell those assets to get their loan paid off. The bank always gets paid off first. They have a first position in their on the assets. So we always remember that. Banks, and there's lots of bankers out here, but I always tell my clients, banks are risk adverse. I mean, they have to make good loans to get paid to keep their doors open to make more loans, right? So if that equates to being risk adverse, then that's what I'm going to say. But basically, they want to be successful in their business operations. So they want to get paid back, and they're in a first position on the assets. They have stringent lending requirements. We go through these loan package items, and they want to get a full picture of the business because they want to make sure that they're making the right decision. Banks need to adhere to regulatory policies and audits. They just don't randomly merely go through their business. They're audited and they have to adhere to policies and procedures. And so they have to look from that lens when they are looking at approving a loan or not approving a loan. I think this point number 4 that I've highlighted in red, I think is very important. When I work with clients, I say relationships with your lenders, your bankers are important. Don't only shop for an interest rate, because 0.5% or 1% different in an interest rate may not be worth it if you don't have a solid relationship with that banker and a relationship that they're going to move with you in the business. If the business needs to grow, they're going to be there for you. If the business is struggling on hard times, they will be more apt to work with you. So really think about that relationship with your lender, and is it solid? How is it? Are they there for the long term? So when we look at commercial financing,
Julie, can I add to that relationship with your banker?
Absolutely.
It's so crucial to have open lines of communication when it comes to your banker. And if it's hard making payments and you don't communicate with your banker, it's going to be tough because you're going to lose that trust factor. So if you're falling on hard times, the first call you should make is to your banker and telling them, I'm having a hard time, or I see some, forecasting, I may have some trouble here, and then you can be ahead of it. And that's going to be a good business owner will know where they're at, where they're going, and they can forecast for the next 6, 12, 9 months, whatever it is. And then if they see something that's going to be slow, a phone call to your banker of, hey, I see some slow times coming. I just want you to be aware. And that goes a long way with the banker, because that trust is there, that they're telling you what's going on within their business.
Thank you, Matt. Yeah, I think it's super important. And I tell clients it's okay to shop for a banker, that, because you want to feel comfortable, and you just because you don't, you don't buy the first car you look at. So maybe you shouldn't, work with the first lender necessarily. And hopefully you guys aren't sad that I'm saying this, but, sell yourself. And if you've got confidence in what you're doing, they'll be gravitated towards you. So it's you have to bring in cash, but then you're going to work with a lender. And so why we are, again, we're talking about this loan package. We prepare and we present to the lender because you want to make sure that you have answered all the questions that you can, so they feel comfortable in their lending requirements, and it fits within their lending policies. Other sources. So I just want to hop back to this slide that I talked about. So we talked about the bank. Now we're going to talk about these other sources of loans and financing. So I'm not going to give a lot of detail here. We could have a whole presentation on just how these different programs work. But at the SBDC, we look at gap loans, and gap loans are more geographically based. We also work with clients with SBA loans, particularly the 504, which is an actual loan, and the 7A, which is a guarantee program. And we can provide much more information. So when we're talking about these other sources of financing, the gap loans or the SBA loans are usually in a second position behind that primary lender. So if you default on your loan from a gap loan, they get paid off after the bank gets paid off. And potentially there might even be a third position. If the SBA is involved, it might be the bank in a first position, the SBA in a second position, the gap lender might be in a third position. Interest rates are not always lower than banks, because sometimes they are, but they might not be, but they're in a much riskier position, right? Because they are taking that second or third position. And there's a separate approval process for these types of loans separate from the bank. We usually work simultaneously, so we're not wasting times. The gap lenders and potentially the SBA will get those packages at the same time as a bank might get them. Usually it requires the bank approval first. I'm going to have Mike hop in because he manages a gap lending program. What other information should we share, Mike?
Sure. Just to clarify or define gap, a gap exists when we have a variable between where the bank wants to be in their loan to value and how much money the borrower has to put in. So if it's $1 million project and the bank wants to be 75% loan to value, then the borrower needs to come up with $250,000. But a lot of people don't have $250,000. So maybe they have 150, that leaves $100,000 gap. So that's where gap lenders like to take that dance. We take a look at, we administer funds. We have a number of pools of money that we pull from for our revolving loan funds that we do as a gap lender at Cass County Economic Development Corporation. And we really look at that as, without our involvement, this project doesn't proceed. So it meets our mission of building jobs and assisting businesses by coming in and serving in that gap function to fill it in. But you're right, it still goes through an underwriting process. Still have them work with an SBDC consultant, because the gap lender also needs to see a loan package. And gap lender also has a finance committee and loan boards that have to approve these requests for funds. But taking a second position, sometimes a third position, it's not enviable, but again, we tend to be a little more civically minded as far as if we're not involved and this project doesn't proceed. That's why we're willing to take a riskier position. Our loan funds, we're at 3% to 4.2%, I think is probably the highest money that we've lent out. We like to be in that 3 to 3.5% range, again, because we like to see things get done. Being involved in an SBA 504 program sometimes doesn't make sense for a gap lender, because we end up just minimizing what NBFC takes, but that's a whole different discussion. The point is, so there are some gap lenders that can do the entire project. It might be one that a bank wouldn't really look at. For instance, we've done straight inventory loans for food costs for a startup food truck, and it was less than $14,000 request. Well, that's something that a gap lender can just come in and serve as the primary lender for, because we have a lot more flexibility on those types of funds. So Entrepreneur Fund, they're an active gap lender. They're also serving as a lead lender oftentimes nowadays. Initiative Foundation has good gap funds. Region 5 has gap funds, and there are other gap lenders out there. Bladec, who's on the call, they have gap funds as well as direct lending. So the point of all this is there's 10 or so potentially different gap sources to help get things done, and your SBDC consultant certainly knows the right people to talk to and the right organizations to get the correct information to in order to give these things the best chance of happening.
Thanks, Mike. Great synopsis. And I just want to echo just a couple points that Mike mentioned. So gap lenders, I always say they're still risk adverse, but they're willing to take more risk because they're looking at the economic benefit of that business being in that community and helping that community thrive, because they want the community that they're representing to be solid and sound and grow. Gap loans, geographically based. So the same possibilities in Cass County might be different in Crow Wing County, might be different in Todd County. So they're usually geographically based, and that's why, you know, we at the SBDC try to keep a pulse on all the gap funds that are out and about to best match those sources with the needs of those clients or those business owners. So thank you. So we're still on component number 3, the source and use statement. Remember, the uses are what we're spending the money on. This is how we're going to fund it, the source of these funds. Okay, so we use the information that we pulled together between the source and use of funds to help determine a financing structure. We may look at multiple financing structures with the gap lender, without a gap lender, with the SBA, without the SBA. What's best for the client? You know, maybe, you know, small payments equal a longer payback period. Larger payments equal a shorter payback period. We look at terms, we look at rates, what makes sense. Interest rates may vary. So all these questions come into the financing structure. And the part that we haven't talked about that also helps determine the financing structure is the collateral position, which we are going to talk about next because it's component number 4 of our lender's checklist. The main point that I want to bring into here is this financing structure flows into our cash flow projection, which is going to say, you know, can we afford to take this loan on? And that cash flow is going to help that. So let's move on to item number 4 on our lender's checklist, and that's collateral. So basically the definition of collateral is the borrowing capacity of the assets that either the business already owns or they are going to purchase. And this borrowing capacity will help determine the financing structure. I'm sounding like a broken record. Here's what I'm saying again. Projects are never 100% financed. And I put never in quotes because, you know, in business, you never use never and always because it's going to come back to haunt you. Very, 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 very rarely are projects 100% financed. So when we look at the collateral, we actually go, if you remember these project cost categories, remember we said split them out between land and building, equipment, inventory, working capital. The reason we did that is because when we complete the collateral analysis, it goes by these broad asset categories or asset types. When a bank is looking at financing land and buildings, they will typically lend 70 to 80% of the fair market value or the appraised value or the cost, whichever is less. So we look at if a building is projected to cost $1 million and it appraises at $1 million, a bank may be willing to lend $700,000 to $800,000 on that building. And you say, why are they not going to do that extra 20 to 30%? And again, lenders are looking at it. If that business owner defaults on the loan and they have to take that building into their possession and sell it, they're hoping to get $700,000 to $800,000 back on that building in order for them to pay off the loan. They don't know what condition that building is going to be in. They don't know how long it's going to take for them to sell it. Are there back taxes that they need to pay? Are there improvements that they need to make in order to sell it? So they want some wiggle room to be able to, if things go south, if things go badly, that they can still pay off the loan if they need to. When we go to the next asset category, equipment, I have 50% down here. And this is where this gets tricky because different lenders look at things a little bit differently. These aren't set percentages. They're guideline percentages, if you will. But when we look at equipment, it's usually around 50%, especially if it's like office equipment and computers, because once you take that stuff home, it really loses its value. So if there's $10,000 of equipment needs, the bank's going to lend you $5,000. If it's things that really hold their value a lot, like maybe a Bobcat or a CNC machine, maybe they go up to 60 or 70%. If they're utilizing an SBA program, maybe they go higher. But we usually start at that 50%. Inventory, what's the collateral, the borrowing capacity of inventory? Could be 0, could be 50. Why would it be 0? If it's a restaurant, if it's food products, banks don't want to lend to fund food products because if that restaurant's refrigeration fails, their freezer fails, that food goes south, they can't use it. There's no way that bank's getting their money back. For 50%, maybe it's things like hard tangible raw materials like wood or nails or something like that that's not going to lose its value, that doesn't spoil. Banks will lend up to 50% potentially on inventory. Working capital it's money for things like utilities, advertising, insurance payments. It's money going out the door for regular operations. There is 0 borrowing capacity on that because once that business writes the check, that money is out the door. There's nothing that the bank can fall back on if they default on a loan. So there's 0% borrowing capacity in working capital. So we look at all of these components, and I'll show you the spreadsheet that we look at to help determine how much a bank is willing to lend, how much a gap lender is willing to lend. Remember that the bank is in the first position. Other lenders are in second and third positions.
Julie, if I could just jump in there. Sometimes we see projects, loan requests that have blue sky business value in there. And, that's obviously when you're buying an existing business and that business value has no collateral value to it. And oftentimes, whatever that amount is tends to have to be handled completely outside the loan request.
Thank you, Mike. I just made a note on my information to add that in there. I don't know why that totally makes sense because there are oftentimes goodwill or blue sky comes in. If a business owner is selling their business and let's say an employee wants to buy it, there might be some value. Hard to finance though, because banks don't take a position on blue sky or goodwill. So oftentimes that's financed by the seller, really. And again, we can talk through all that when we meet with you as individual consultants. But, okay, so again, I want to show you the format that we use at the SBDC. So this is a snip of our collateral analysis. And you can see I've got accounts receivable in here, and I've got, is it new equipment or used equipment? So it might have a little bit more detail than the previous slide, but basically we look at what's the fair market value or the appraised value. If we don't have that information at the time, we as the SBDC consultants will help the clients put together the costs. What's the cost of those items? And that's what we'll start with. Okay, but remember the bank loans on the lesser of the cost or the appraised value. So here are those bank percentages. Here's the gap lender coming in a second position. Here's the total collateral percentage, or as you heard Mike say, loan to value. What's the loan percentage to the value of those assets? And this is where we get the lending amounts and how it's broken down. Is it a real estate loan? Is it equipment inventory? Is it a gap loan? Again, these percentages may vary. When I say typically needs full collateralization, if the bank and the lenders want to have a collateral position. So if your project costs, if the collateral value is only $100,000, the lenders aren't going to lend $150,000 because that's there. It's under collateralized. There's not as many assets. The value of those assets are lesser than the amount of the loan. So again, we will walk with you through that process, but this is what our collateral analysis looks like. The last topic that I want to make on this is the reason again that we break down these asset types into these categories is because loans have varying terms. For land and buildings, typically 20 years, and you can see my typical is italicized. Some loan programs may go out to 25 years on real estate. Equipment, usually 5 years, may go to 10 years. Inventory, 3 to 5 years. And we typically see it at a 5 year. Working capital, again, why am I even putting this in where I say depends? So let's say you need money for working capital and you have an extra asset. You have a piece of equipment that you own that you are willing to pledge as collateral for that loan to fund that working capital. Well, then that working capital loan is based on that piece of equipment, and it could be a 5 year term. So again, this gets complicated and we have lots of structures. We will help you walk through this process to hopefully solidify what this financing structure would look like, what the terms will be, where the interest rates will be.
Hey, Julie, I just wanted to add, special purpose properties inside there as well. There's a much lower loan to value that could come up, and just even the number of years that a bank is willing to finance it.
And you want to, what would Matt give an example of what a special purpose project would look like or building? So we have an example.
Yeah, let's take an auto repair shop. If an auto repair shop actually has a pit at their facility, well, that's a special use property. I mean, you can't just turnkey it. If somebody ended up wanting to purchase that property, if the auto mechanic didn't work out, they have to figure out what are they going to do with those pits? Do they have to fill them in? And then does the building still stay special purpose? Where if you have an auto mechanic that builds a new facility and they just have a flat surface and they put hoists in. So there's different ways to look at how they're going to build a building. And that's where, you have discussions with your bankers of, are they going to consider that special use or not? And it may change how they develop their blueprints for their project. If they're building or if they're buying, do they look at a different facility so it's not considered special use? Because that'll also affect any type of SBA financing as well.
Matt, perfect. And I took out the detail to hopefully unclutter, but yes, SBA definitely looks at special purpose or special use projects. So thank you for bringing that up. And I have a follow-up point. When business owners are trying to finance bare land, I have often heard that they will, like lenders want to use a 65%. Is that still a true percentage, or can we look in those higher ranges of 70 to 80% on that?
I would still say we're looking at a lower percentage on raw land.
Okay. I'm making a note of that because, that's because sometimes a business owner will say, I'm going to secure the land first, and then in 2 years down the road, I will build. So again, that could be a part of this whole process. But those percentages might vary just because it's bare land without a building on it. So again, there's lots of different scenarios that we can think of, and hopefully we at the SBDC can help you work through those. Okay, so let's get caught up here. Where are we? So again, we're talking about the loan package. This is where we are at. We've covered all the things in blue. The things in red are yet to be covered. So let's dive forward. So all these things that we've talked about in terms of the numbers, the historical financial statements, the summary of project costs, the collateral analysis, help us provide information for the financing structure and also information that we can put in the projection. So when we look at a projection or a cash flow, what are we talking about? So here I'm looking at, again, this project needs to fit in the cash flow. What does that mean? A cash flow basically looks like a bank account. It measures the inflows of cash. It measures the outflows of cash. At the end of the month, we come up with a cash position. Where is that cash position? Where is that balance of your bank account? Is it positive? Is it negative? If we do a cash flow projection and it's negative, lenders aren't going to like that very much, because that means you don't have enough money to pay your bills, to pay the principal and interest on the loan that you're requesting. So we really look at that and want to see a positive cash position. And I put in here this very technical term, with wiggle room. Hey, just because you have a positive, like $1 of positive cash position, is that going to be enough for a lender to provide a loan? Probably not. They want some wiggle room. So if the owner breaks their arm and has to hire an extra employee, well, that's going to increase expense, right? Decrease the cash in their account. Can they still pay all their loans? Can they still service all of their financing or pay for their utilities? If there's some upturns in the economy, downturns in the economy, is there enough wiggle room in their cash position to make sure they can make all their payments? Lenders like to see growing cash. Is the trend of that cash going up? We know in the Lakes area, we have high seasonality to our businesses. You have to make, most businesses have to make their money in the summer because they know in the winter their cash position might decrease. They still wanted it to be above a positive position though, right? Even with those decreases, they still want it to remain positive so you can make all of your payments. The other thing is lenders would like to see that you can fund capital expenditures. They know that you might need a small piece of equipment next year, or maybe a little bit of an improvement to your building or an upgrade. Can you fund those? Is there enough cash that you can, make those capital expenditures and maybe not always have to go to the bank to finance those things? So when we are working with business owners to look at their projection or their cash flow, this is what we're looking at. We want to make sure that the inflows of cash are greater than the outflows of cash so you can service your debt and be on stable financial footing. Now, we could have one whole session just talking about the cash flow projection. This could take an hour by itself. I'm briefly giving you just a taste of what we try to help business owners do. When we look at a cash flow, there's a time period. It's usually over a year or 2 years. There's seasonality that we need to take into account. If you're a restaurant in the Brainerd Lakes area, you're not going to open a business in October. That's going to be going into your slowest season. You'd want to open in April so you work out the bugs. By the time May happens, you are getting into your busy season. You earn all that cash so you have money in your bank to go through that slower season. So we look at that seasonality. It's hugely important. Expenses are usually easier to project because you call the telephone company. How much is your telephone bill going to be? You know what you're going to pay for your wages. You work out a schedule. You project what those wages are going to be. They are easier to project. It's hard to project how many sales you're going to have. You don't know how many customers you're going to have coming through your door. But we want to project it at that lowest common factor. So if you're a retail store, how many people do you think are going to come into your store on a daily basis? What's that average ticket price going to be? So we can visualize, yeah, we can see that 50 customers coming in a day, that makes sense. If we have to have 200 customers coming in every day, that might not make sense. So when we look at sales, don't just say I'm going to have $10,000 of sales a month. What comprises those $10,000 of sales? And we can help you look at that and say, is that realistic? Is it not? Here's the process. We do a rough draft, we research, we fine tune, and we repeat. So this cash flow projection process, it's not one and done. We want to better that information and have as much solid information as we can. And this is where that research comes in. How can we find out more information? How can we fine tune that information? Let's see what it looks like, and let's repeat this process to really hone in on a great projection. The SBDC can assist you with this. Mike, Matt, anything to add on that?
No, I don't. I think without, like you had said, getting into an hour-long discussion on it, I think you did a very good job with that, Julie.
I agree.
Okay. And it's the primary, this determines in Mike's words, the should or the could. How does the projection look? Does it have positive cash flow? So maybe it's a should and a could. It's my financial feasibility. Does it cash flow? Then it makes sense from a financial perspective to potentially move forward. I always say that it is better to fail on paper than fail in the real world. So our projection process is like this mountain climber, rock climber. You think he took this cliff the first time he decided to climb a face of a mountain? He started small. So we're trying to work through that process to help you potentially not fail at all, but it's better to fail on paper than in the real world. And we want to help you through that process. Not failing, success. We don't want to help you with the failing process. So as we move forward, we are now on line item number 6 of our loan package. We want the lenders to have access to any legal documents, your articles of incorporation, articles of organization. Do you have a lease agreement? Is there a sworn construction statement? Might you have an old appraisal that we could include? This is a component of the loan package, and we want to include that information. And there might be other types of legal documents or formal documents that you want to add if they're applicable to the loan approval. Again, we're trying to get all this information so the lender has everything that they need in order to make a solid decision. The personal financial statement, I believe that's number 7 in our loan package checklist. The personal financial statement is basically like a personal balance sheet. It shows the assets, what you own. It shows the liabilities, what you owe. How does it look? Is it solid? Hopefully you have a positive position. You have more assets than liability. Banks have their own form that they use. The SBA also has a standard form. So let's say we work with a business owner and they don't know what lender they're going to work with. We utilize the SBA forms because pretty much all lenders recognize those SBA forms. So we can help you with this, help you prepare this personal financial statement to make sure it's accurate, up to date, includes all the information. I also put, here's that credit report again. The lender will run a credit report on you. If you have one from your, like a credit card statement that you can include, not a bad idea to include it in this personal financial statement section of the loan package. Again, Mike and Matt, if you have anything to add on these, please feel free to pipe in.
Julie, just wanted to jump in and remind, or just notify you that it's about 10 after 11.
Okay.
I want to make sure that we have some time for Q&A, especially in regards to maybe any updates from Rebecca on regarding COVID-related lending. So
perfect. I think we'll be less than 5 minutes. So
okay.
These are the easy parts of the loan package. So the personal financial statement. Number 8, and again, we are talking about those 9 components of the loan package, is a resume. Lenders want to know who you are, what you do. That format can be flexible, but it needs to be current. And I always say that the resume should show the abilities that relate to the loan request. So if you're a hairdresser and want to start a restaurant, Ooh, okay, that might be a far reach. What in your resume are you going to show that because you are a hairdresser gives you the ability, or it ties into owning a restaurant? So what kind of abilities do you have that make sense with the business that you are entering in, or you are requesting a loan for? Again, banks have their own forms potentially. We at the SBA have a standard resume format that we use if you don't have your own. Last but not least, the 9th component of that loan package is the personal tax returns. Lenders want to see the past 2 or 3 years. They show earning history and stability. And it also will show potentially what income you're giving up. If you're quitting your job to start a new business, what does that business have to replace? What income did you previously have that the new business or startup might have to replace? So this is information that they will want to see as well. That is the 9th component. So we have talked about all these 9 components highlighted in blue. That's our loan package, our loan packaging checklist. Here's where it ties into those 5 C's, what a lender wants to see. You can see that condition and character are covered in the business plan. Capacity in all these, in multiple areas, how much you have to repay that loan. Collateral is in the collateral analysis. The credit analysis is in your personal financial statement. So the reason why we at the SBDC include these items in our loan package is because they really cover those 5 C's and what the banks need in order to make a good lending decision. So basically, when people come into our office, they have an idea. We help them in this planning, loan packaging process to hopefully gain and secure a loan to have them achieve success in their business. I think it's a full circle, and we want to be a part of that process and hopefully help business owners out there. So these are the topics that we covered today, and we're here to assist you. So that gives us some time for questions and answers, and Rebecca to cover maybe updates on the PPP, or not the PPP, but just, COVID related programs. So that's all I have.
Julie, I just wanted to add one thing when we talk about raw land, and if somebody does secure that raw land and they're going to wait for about 2 years, to really check with their lender on what they should or should not do as far as improvement to the property, just because it could be considered as early start coverage. So it could create more cost if they start developing the property before they have financing knocked down.
Good point. Thank you, Matt. I made a note in my, I can cover that in a presentation too. Thank you.
Well, thank you so much, Julie and Mike and Matt. It was really informative. And I know that we also promised some Q&A. One of the things, if you would do me a favor, Julie, and just stop sharing, and maybe you can put the contact information in the chat. There's a small enough group here that if you want to ask the question on your own, you certainly can. Do me a favor though, and just go to reactions on the bottom of your screen. Click that and raise your hand. If we have multiple, that's probably the easiest way to handle that. Before we get into that, Rebecca, do you want to just do an update, or would you prefer specific questions? Do you want to, in regards to COVID-related financing and what currently is going on? It's kind of a broad topic.
I'll just do a quick update and say that within our presentation today, we just received notice that the Restaurant Revitalization Fund will begin registrations this Friday, April 30th at 9 o'clock Eastern time, so 8 o'clock Central. And the Restaurant Revitalization Fund will open for applications on Monday, May 3rd at 11 o'clock Central time. And so with the Restaurant Revitalization Fund, I simply seek to share information with everyone. I think we all benefit from restaurants in our community, and it's very important that eligible applicants for the Restaurant Revitalization Fund apply early, because there's only 28.6 billion currently available in funding, and it's expected that demand will exceed 100 billion. So again, connect with the SBDC. There's a bunch of webinars going on this week on the Restaurant Revitalization Fund. The North Central SBDC is hosting an application workshop tomorrow morning at 9 a.m. We welcome participation. We're doing that webinar tomorrow in collaboration with the Minnesota District Office and the Deputy District Director of SBA for the state of Minnesota, which is Twyla Kennedy. And so we look forward to that. A couple additional notes with the Paycheck Protection Program. So the third round, the round that opened in January, had 284 billion. We know the American Rescue Plan Act added about 8 or so billion, but we know as of April 15th, there was a burn rate of about 1.5 to 2 billion a day. And we expect the funding to be used up really in the month of April before the May 31st deadline. So it'll be interesting to see how that does proceed. And as Mike mentioned, EIDL remains available. The application deadline and covered period has been extended until December 31st, 2021. The loan limit is up to 24 months economic injury with a maximum loan amount of 500,000. Julie or Mike or Matt, do you have anything to add regarding COVID-19 programs?
No, other than they tend to change frequently and quickly. So, you could always check in with your SBDC consultant for the latest, or sba.gov if you have time to filter through and find the answer yourself.
I'll just echo that. Same thing with Mike. Yeah, call us if you've got questions. Call your lender. Check websites. Yeah, there's lots of information, and it can change.
So I do see a couple people off mute. James, or I think that's Troy. Were you interested in saying anything, or did you accidentally take yourself off mute? Or maybe that was an accident. Okay, so there is a question from Tim Swanson at Franzen. He just said, are there any good websites, resources, or templates that you would recommend for preparation of business plans? That they often get that question from prospective business owners.
Can I jump on that?
Sure, go ahead.
Hi, Tim. Thanks for the question. I would say the best thing to do would be to refer them to the North Central SBDC, assuming they're in our Region 5. And the purpose of that is that we can start working with them on that business plan, that we have the outline that we'd like to share with them. But then we can also stay engaged with them and make sure that they don't get tripped up along the way and maybe quit or give up. Sometimes we become kind of the cheerleader to make sure they believe that they can do it. So sometimes I believe that's best. So my personal opinion is just to go ahead and refer them direct to a consultant who could get them registered, or to Rebecca who can get them registered and then parsed out to a consultant.
Yeah, and there's so much online business plan templates, but like you were saying earlier, Julie, sometimes there's a lot of extemporaneous stuff within those that a business owner might not need. And what I often see is people get overwhelmed getting into this process, and then, like Mike said, they just give up. And little by little, if you have the relationship with someone like you, Julie, or Mike, or Matt, or another partnership with a banker, they can really, really help you walk through that and to not give up. That's probably the biggest thing.
And I just want to make one more comment about the business plan. You can download a template where it's a fill in the blank, like they ask you a question and you fill in the blank. and then you spit out a business plan, and it reads like you put information in a template and it spit it out. It's not in a natural voice. And we could have I have a whole class on just the business planning process and creating it. It's narratively. You are telling the story of your business. So write how you speak. I mean, you want to use appropriate grammar, but it's your story, and you want to give that lender the feeling that you're telling your story.
Great. Any other questions or thoughts that you have, experiences that you want to share?
Paula, I wanted to make one note as well. As Paula shared at the beginning, one of my past experiences was working at SBA in Washington, D.C., where I was for about 5 years. So it's interesting to see how the SBDC operates really on the ground level compared to perspectives about SBDCs while at SBA. And something that I have seen through my about 3 months here thus far is I really encourage businesses to establish a relationship with an SBDC consultant so that when they need assistance, they can reach out. And so maybe perhaps a business does not need assistance at this point in time, but you have the capacity now to reach out to the SBDC, to become connected with the SBDC, and to start developing a relationship with Matt, Mike, Julie, or the many other consultants on our staff. And so to me, that's been a good tip that I've seen work successfully for businesses throughout the area.
I just have a really big point to add. The SBDC services that we provide are free. There isn't a charge for people. And I don't think that I mentioned that or anybody else has. So there's, really where do you get something for free? To me, it's a really great deal, because I think we're pretty nice people for the most part. And we like our jobs, and we like to work and help businesses, and there's no cost to you. So really, you're not out anything except some time and effort, and hopefully it'll be a good decision if you decide to reach out.
Well, and I run across a lot of people that are working for a larger organization that want to start their own business. So that's sort of how this webinar came about. And we had another person who is a director at a pretty large organization who purchased a company. And he said, oh my gosh, I had no idea how intense this was to do that. And so that's where this really initiated from. So I'm glad we have this resource now to point people to even just do, that overview of what's offered from the SBDC. So are there any other questions or comments? Anything else?
I did want to clarify, it's not just brick and mortar businesses. It's not just somebody who's starting up and looking to make a large investment. We deal with solopreneurs, people who just want to create their own job. That's a business, and those need to be treated as a business. And we are going to work with them the same way that we are going to work with a business making a $1 million investment. So it's all important to us, and no project's too big or too small.
Thanks for mentioning that, Mike, because, well, as you guys all know, I don't know what the number is, 85% of our membership are small businesses. And that's maybe 20 employees or less. And I would say a good chunk of that are 5 employees or less. So, and that makes up a huge part of our economy. Anything else from anyone? All right. With that, thank you so much for being here. Appreciate it. And a couple updates. One is Supervisor Advantage is coming up May 12th. We still have some openings. We're hosting those in the land services rooms at the lower level of the county. So if you know someone who could use some supervisor hands-on skill building, that's a great class. Our business to business showcase is coming up, and the last day to purchase a booth is tomorrow. And I think it's going to be a lot of fun. I want to say there's maybe 40 or 45 different booths that have been sold. So it's going to be a lot of fun just to be together. And then many of you have asked about our leadership experience. Normally we start in January. We've delayed that this year. And our plan at this moment in time is to start in September with our retreat in September and go through May. So that's the update with our leadership experience. And with that, that's all I have. So thank you all again, Rebecca and Julie and Mike and Matt for being here. Appreciate it. Bye.